I'm Meg Green with AM Best TV. We're in San Diego for the Wholesale and Specialty Insurance Association's annual marketplace. Joining us now is David Blades. He's Associate Director at AM Best. So David, you just did a report looking at the surplus lines sector. What's the big takeaway?
I think first and foremost, we always look at the growth in the marketplace, and I think the fact that the surplus lines market grew by 11.2%, which is double what the total property casualty industry grew by. I think that was very telling in terms of surplus lines underwriters being able to take advantage of opportunities in the marketplace at the current time. It's also, I'm sure, endemic of the economic growth that we're still seeing in the country. And also, surplus lines is probably 85% commercial in nature, and commercial rates for most of the lines of business have been growing or have been rising. And so, I think that's also something that propelled the premium growth in the last year. But I think that's a major takeaway, seeing that level of growth. It's the most that we've seen on a year-to-year basis since 2012. I think also we always look at and focus on the performance of the market. And again, from a performance standpoint, the surplus lines market definitely in the last 2 years, has been hit or has been affected by, the wildfires that we've seen, and also weather-related catastrophes. But in general, the core group of surplus lines companies, again, those that focus specifically on surplus lines, have done very well over time in terms of their combined ratio, both on a net basis and definitely when looking at business on a direct basis. And that means taking out the noise from either assumed or ceded reinsurance. When you look at the performance from that standpoint, surplus lines companies have definitely outperformed the overall property casualty industry. I think surplus lines market is dealing with a lot of the same things also that the overall PC industry is dealing with. We had a webinar for our report a couple of Fridays ago, and we talked about just still bridging the talent gap and bringing new talent into the marketplace for surplus lines insurers, and also for surplus lines intermediaries, for the wholesale brokers and the MGAs that are really the backbone of the industry. And companies have developed a lot of different initiatives and different strategies to not only attract people coming out of college, but also to retain them over time. You can develop the greatest strategies in the world, but you still need those professionals on a day-to-day basis to be in there, to be highly trained, to be motivated, and to be able to actually execute those strategies.
Were there any surprises in the report?
I think from a surprise standpoint, I think one of the things that we continue to look at is just some of the areas where surplus lines is growing. And I looked at, and I was actually a little bit surprised when I looked at, from a year-to-year basis, the way surplus lines insurers are coming to the fore for cyber insurance, cyber risk. In the last year, surplus lines premiums in terms of writing cyber risk insurance grew by 53% based on some numbers that the NAIC just put out. And that's a big jump from a year-to-year standpoint, from 1.2 billion to 1.8 billion. It was, a significant part of the overall market. I think about 38% of the overall market for cybersecurity. So I think, we're seeing surplus lines insurers do what, I can think what the kind of nature to them is bringing different strategies and different solutions to the marketplace, utilizing the freedom of rate and form to bring those kind of solutions to the marketplace. We also, for the first time this year, looked at our best credit rating methodology and kind of looked at surplus lines companies specifically in terms of how they compare to our assessments of the overall property casualty market. And when I looked at operating performance, when we looked at balance sheet strength, when we looked at business profile in particular, and enterprise risk management, sort of the four tenets of our best credit rating methodology, surplus lines companies, the assessments, the overall assessments, the percentages at the highest levels of those assessments were definitely compared favorably to the property casualty market. That was something, again, we hadn't looked at before, and so it was a little bit surprising, particularly when looking at business profile, whereas most of the property casualty industry we look at, and again, it includes the smaller companies, single state, single line writers. Most of those companies we've looked at, we kind of consider them limited from a business profile perspective, but for the surplus lines companies, the majority of them were at either adequate or higher in terms of our rating, our assessments of them. So I think just looking at how strong the companies are in terms of their identity, in terms of their product diversity, in terms of their overall geographic diversity. I think that really kind of is a little bit surprising in terms of how that graded out in comparison with the overall property casualty market.
And what's your outlook for the surplus line segment?
I think right now, AM Best has a stable outlook for the surplus lines market, and it's the same stable outlook that we have for the overall commercial lines marketplace. I think for surplus lines companies, as we've looked at them, we look at them, and that stable is based on very strong risk-adjusted capitalization. So in terms of surplus lines companies and how they're managing their investment risk, their credit risk, their premium risk, the loss reserve risk, all the risks that go into looking at a balance sheet. AM Best has looked at that favorably for surplus lines companies, and again, I think that's kind of the backbone of the stable outlook. Again, also from an operating performance standpoint, when we've looked at surplus lines companies over time, we've seen really strong adherence to proven risk management and risk selection tenets as far as their overall strategies, and we think that definitely plays into strong operating performance, again, comparative to the overall property casualty market, and that's what's going to maintain that strong balance sheet strength over time. And again, as I mentioned, from a business profile standpoint, we look at surplus lines companies as being diverse, being well entrenched in their individual marketplaces, especially when you're talking about the top 20, 25 surplus lines companies in terms of generating premium. Those are companies that are well entrenched in the marketplace, well established, have been devoted to this marketplace for a long time, the surplus lines and specialty marketplace. And I think that goes into the stable outlook that we have at present and looking forward over the near term.
Great. David, thank you for speaking with us today.
Thank you, Meg.
For AM Best TV in San Diego, I'm Meg Green.